Today, we're going to be diving deep into global financial infrastructure and where it's heading, from blockchain settlement to tokenization, digital policy, interoperability, and what this means for real adoption. We're joined by Andre Casterman, founder and managing director, Casterman Advisory, and board member at the International Trade and Forfeiting Association, as well as Arushi, from a former policy lead at Chainalysis, as well as the World Economic Forum, and advisor to multiple Web3 firms. Want to give a huge shout out to XDC Foundation for helping us to put these together, and preface nothing that you hear today is financial advice. That being said, let's hop into the big picture. Welcome, Arushi and Andre. Thank you guys so much. So if you zoom out over the last 10 to 15 years, as we start here, how would you describe the journey from early blockchain experimentation to today's institutional tokenization era? What changed to bring us to this point? Let's start with Arushi.
Thanks, Solomon. And that's a pretty comprehensive question at the very start. Um, I think 10 to 15 years, if we were to take a step back, I would kind of break down the journey into three phases, right? We had 2008, we had the Bitcoin white paper, and it was born out of this financial crisis. And there was this idea that, hey, we don't want to rely on intermediaries, right? That's the ideological idea behind it. And then we had Ethereum, and we were talking about programmable money, and the whole period, starting in 2008 till I'd say 2015, 2016, it was really about building that base layer. So it was a lot of infrastructure conversation as well as experimentation. And then I think we enter kind of the second phase, which kicks off around 2017, which is when, emerging markets started adopting Bitcoin and other forms of crypto. And we had this big Libra moment for the ones who've lived through it, right? Like it really jolted regulators globally. Suddenly, the conversation changed. People realized that if this was going to be scaling so quickly, without any structure, this could virtually reshape parts of financial system way more quickly than regulators could adapt. And at the other end of the spectrum, we had these enterprises which were starting to lean into permission chains. We had, R3, and we had a lot of CBDC conversation. I'm sure Andre and I were both engaged in a multiple supply chain pilots. So that was really the conversation. And this was a time when stablecoins came to be to what we know them as today, right? It was a first real global use case. That said, it was still a fairly messy era in terms of we had very little regulatory clarity, a lot of focus on the crime that was being enabled by crypto, and still a very, very fragmented ecosystem. So we saw that the tech was solving some very genuine issues, but it was still fairly messy. And I think the last few years, starting from 2022 onwards, we saw that for the very first time, both regulatory clarity and institutional interest have kind of come together, right? We see jurisdictions like UAE, where I'm based out of, Singapore, Hong Kong, even to a certain extent Europe and now US, they're starting to move fast in terms of how crypto and all these other products should be regulated, right? And I think that's changing a lot because now institutions are not flying blind. They are seeing some clarity in which to operate, and so that journey has obviously been very dynamic and very, very interesting.
100%. It certainly has been a journey. Andre, thoughts on the digital transformation journey?
Yeah, I think the technology, when relevant, because we have seen technologies that have become irrelevant over the years, but technologies that are relevant, are meant to be impactful, always win, even when incumbents are fighting it. So we came, as Arushi said, from 2008 financial crime crisis, global financial crisis, and the initial Bitcoin white paper, I think January 2009, was an experiment by experts, mathematicians, cryptographers, and a few techies. And here we are, 2025, and those technologies in their different forms, bitcoins, ethereum, xdc, and the thousands of digital assets and the number of use cases we're going to debate about are becoming a geopolitical priority. So we went from the dark room of experts playing and kids really playing with it in their bedrooms, buying Bitcoin without knowing where that the money was actually going, to really politicians fighting to attract the crypto talent on their soil. So these are the two extremes I'm fascinated by. And as Arushi said, there were multiple phases, which I followed since 2015 approximately, when I left Swift to move into the digital asset and trade finance space from a tech perspective. So I do remember those phases. And we are still, I think, very early in this journey.
For sure. I kind of want to, this leads us nicely into kind of the current digital infrastructure landscape from the perspectives of global trade networks and global policy organizations. What does the digital infrastructure stack of today look like? Where are we seeing, and I think this is really important, where are we seeing meaningful standardization, and where are some of the gaps in standardization? Because at the end of, like, what I think from some of these interviews I've kind of seen is it really is kind of that uh, the regulatory gaps needing to be filled and industry standards. But where are we kind of at right now? And I guess I'll start with Arushi. This is probably very familiar to you.
Yeah, I mean, standardization, harmonization are literally words like you hear at every meeting, every roundtable, and we're all trying for that. Let me actually talk about one piece of it. Like you mentioned about regulatory gaps, and I think they're really, really critical to the digital stack. Just as critical as protocols and the rails themselves, right? You can have the best technology, but if the policy frameworks don't support it, scaling becomes a really big issue. So again, I'll put it under three pillars, right? We had the first pillar, which we like to call financial integrity. That's your AML CFT layer, right? So we had, luckily, we had FATF, the Financial Action Task Force, which implemented or brought about recommendation 15 and 16, talking about how crypto service providers and national authorities needed to treat crypto when it came to anti money laundering and terrorist financing issues. So you were required to do customer due diligence, you had to comply with things like travel rule and so on and so forth. And the industry also developed in the sense, we had the blockchain analytic solutions, which kind of took, did a lot of the heavy lifting when it came to doing the transaction monitoring and making sure the due diligence was properly done, bringing that on-chain data into their compliance rule books. Having said that, it's still not fully standardized despite years and years of trying to make it work. Right, the travel rule remains a bit of a mess and a chaos because different jurisdictions tend to have very different ways of implementing this, and the solutions themselves are not interoperable, which also creates issues. So that's the financial integrity layer. The second layer is the market structure, right? So market structure is essentially who gets regulated for what activity, what are the different tokens that you're putting it out there. And here, again, we have some standardization, like there is clarity on certain functions like exchanges, custody providers, broker dealers. So most jurisdictions have a baseline consistency in terms of how these are regulated. And similarly, with stablecoin issuers, we've got reserve requirements, redemption rights, licensing obligations. So there is some standardization that's coming together, but gaps remain, right? Because Nigeria will talk about crypto as a security, whereas in UAE, you have a very specific virtual asset regime, and we have like four other regulators apart from this one. So I think that those gaps remain in terms of how that same product or that same token or that same activity could still be treated fairly differently in different jurisdictions, which makes cross-border activity pretty complex. And finally, and I'll just quickly walk through this. These are the prudential requirements. Prudential requirements are essentially looking at the financial soundness and reliability of institutions holding these assets. And for banks specifically, we've been waiting on the Basel Committee guidance for a while, and they did propose a 1,250% risk weight for these assets, which meant essentially banks had to hold capital uh, equal to the full value of the crypto exposure, which ultimately made it economically unviable for banks to get this kind of exposure. But luckily, we are rethinking it. We finally have an official confirmation that these prudential requirements are going to be undergoing a change of sorts, and then hopefully that will open up the pathway. So, yeah, we're seeing some standardization, but the gaps continue to remain. And as Andre pointed out, we are still fairly early, but we seem to be moving pretty fast.
Andre, I'd love your thoughts. Let's just kind of on where we're at with the current landscape, whichever way you want to take it.
Yeah, another perspective from a trade practitioner's point of view, looking at the digital infrastructure stack, as you suggest, is blockchain has been used a few decades ago. No, 1 decade ago, a few years ago, like 2016, approximately by banks through consortia to communicate, to exchange information. And this is when I was personally not convinced, because I thought we can communicate on the internet using APIs. We don't need yet another piece of infrastructure just to exchange data. Coming from Swift, that was the main function of Swift, is to exchange financial messaging. So I thought this blockchain doesn't make sense to exchange just data. And most of those consortia failed because they didn't take advantage of the power of blockchain, which is all about acting as a registry of assets. And this is what we're doing in trade at the second level, which is anchoring data to prove that the data has been logged and is tamper-proof. So we do that for digital bills of lading, digital bills of exchange, prom notes, as per the model law for electronic transferable records, which is based on electronic signatures, but also a registry of transactions, tracking the life cycle of transaction. Now, those two first use cases, communicating and anchoring data, are not regulated. You can use blockchain without asking permission to the regulators as a financial institution. But the third level is all about moving money on stablecoins or tokenized credits or CBDCs. If some countries want to go that way, there are various options to pay using indeed tokenized money. Once the regulators recognize it at some tokens as money, indeed as currency. And the fourth one, which is the most advanced and has accelerated recently, is the whole point around creating investment products through real-world asset tokenization and packaging this in a way that investors can buy them or fund those transactions. Of course, stablecoins and real-world asset tokenization for liquidity are regulated use cases as they are in the Web 2 world without tokenization. So these are the four layers of the infrastructure stack as we see it from the global trade perspective. Standardization is definitely coming from the crypto space with all the different token standards, very technical. And we know the technology and the internet are global by design. However, as Arushi explains us, the regulators are, of course, in charge of their borders, their countries, their jurisdictions, and are creating indeed borders when sometimes and introducing indeed differences and lack of standardization in how those use cases can be implemented at cross-border level.
I want to ask just briefly here, because I think it's also been interesting over the past 12 to 18 months. We've seen some pretty heavy hitting entities kind of showing, what seems to be showing their hand a little bit on how they're adopting the tech. And Andre, given your background at Swift, I think it's an interesting and kind of relevant question. So at Sibos, which is Swift's annual conference, for those not aware, Swift announced it's integrating blockchain ledger capabilities into their infrastructure, alluding a shift from messaging into payments and settlement. I guess the question I have is, what does this signal to the broader financial ecosystem at large, and how does this change the role of things like shared ledgers in the future of financial infrastructure? I guess, Andre, what I'm asking is, what are your thoughts on Swift announcing blockchain ledger integration. We talked about this kind of briefly before this, but yeah.
Yeah, no, it's a very interesting announcement because of the entity, of course, releasing that piece of news. Now, the reason why I left Swift in 2015 is because I thought the bankers wanted Swift to be stuck in this financial messaging, which is a 1970s use case, and I thought there is more to be done by a huge platform like Swift, dominant in the sector, than just exchanging messages securely. But I thought this mindset will never change. Now it might be changing 10 years later. At 2025, we see finally Swift going up the value chain, moving from messaging to using indeed a blockchain based ledger for transactions, for possibly for settlement. Now, as I have done at Swift 25 years ago, I was introducing new capabilities, new products to financial institutions, to the Swift owners, the shareholders, the banks, and it takes time. It's even when you're Swift, it's a huge risk to introduce a new capability. So I wish them well. Now, the key risk for Swift is that they are doing that in 2025 when lots of players have been doing this since 2013, 15, like Ethereum, like Ripple and Circle and so on, who are already very well established in the cross-border payments space from a settlement and FX perspective. So Swift is this time on this use case the new entrant against some form of incumbents, given the liquidity they have on chain so far. So just a few names like Tether, Circle, and Ripple would be the main ones. So it won't be easy for Swift, even if they own this huge community, which is brilliant. I've seen it functioning for 24 years. But let's not forget that this time on this use case, Swift is the new entrant, and the others who have been far more visionary and daring are the incumbents. We are still early, so there is lots of opportunities for many, but the quality of execution will determine who is going to win market share.
I want to ask Arushi briefly too, kind of an independent question as well. Given kind of the work at policy at the World Economic Forum, what is that like as well? Because there's so many different things from a technology standpoint that the World Economic Forum kind of deals in. And what did you kind of witness at your time there, and kind of what you're seeing with adoption? What are some of the things being discussed at some of those events?
Yeah, so Solomon World Economic Forum was, it is an institution that brings together public and private sector stakeholders on identified issues with the motive to, I mean, the tagline is, to improve the world, to improve the state of the world. So the idea is that we bring together different stakeholders from all walks of life. So any issue or any project or any topic that we would pick up, the idea would be to create as diverse a community as possible, from practitioners to academicians to, people who are working on compliance, on regulation, on technology, for everyone on the same table to talk about very difficult issues. So one of the work that I engaged with very deeply was actually defining the pathways to global crypto regulation. And this was back in 2022 when we brought together a whole segment of 80 plus stakeholders from literally across the world to talk about what did it really mean to talk about a global crypto regulation. Was it even possible? And I think some of my insights from those conversations and the eventual paper that came out was like, we talk about harmonization and global regulation, sometimes in a very offhandish manner. Sometimes that's not even the goal. Your financial sector even is not fully harmonized today, which has existed for years and years now. Sometimes it's more about finding the pathways that support the goal of harmonization, right? Like, for example, the way the funds work in the EU, which has passportability as a critical function. So something similar, but may not be the same, to be done for crypto has been in the works for a while. And we've recently seen, for example, the US and UK talking about a level of regulatory harmonization amongst their regulators. So I mean, just to give you a flavor of, those were some of the conversation, for example, we would have back in 2022 when I was at the World Economic Forum. And since then, obviously the conversations have evolved. I know they're working on things like tokenized assets, which are of critical interest to all financial institutions, as well, delving into the more frontier areas like DeFi as well.
Yep. I'll get into tokenization of real world assets here because I think it's kind of it's definitely the low hanging fruit topic because it is by far kind of the most talked about and kind of, I don't even want to say like niche. It's like, it's just happening. So we hear about the tokenization of everything from trade assets to treasuries, commodities, carbon markets, and more. So I'm going to ask both of you: are we entering a phase where tokenized assets become the default format for ownership and settlement eventually? Which use cases are most likely to scale first? And it's interesting for me, as a sidebar here. Like, I just did an interview with a gentleman who is head of kind of sustainability at one of these entities throughout blockchain, and he was at COP 30, which is kind of the UN big stakeholder type thing on sustainability. And when I look at tokenization, for context for people out there, I mean, right now, excluding stablecoins, I think probably 35, 40 billion, something like that. It seems like we haven't even hit a drop in the bucket yet. It seems like we haven't even misted the bucket yet. But I want to hear from both of you guys, what you think as far as tokenization is concerned, where we're at and where we might be heading. And I'll start with you again, Arushi, and then we'll go to Andre.
Yeah, I think just to quickly answer the first part of the question, no, I don't think tokenized assets are the default yet, by a mile, right? But what I'm witnessing, so I think 2018 was a time when we heard a lot about tokenization. There were a lot of pilots being done, a lot of experimentation that was trying to happen, but that kind of died down after a while. And then back, I think this year again, we are hearing a lot of it. And the pace of change that I'm seeing, having gone through that phase once, is a lot faster. And I feel like it's a lot more sustainable than what we've seen before. And you mentioned stable coins. I think there's a clear consensus they are by far the most successful tokenized asset we've seen today, right? I mean, they're tokenizing something that people already understand really, really well, which is a stable fiat currency, the US dollar, right? They are backed by cash, short term treasuries mostly. The design is pretty simple. And the fact that now we've got regulation in some of the key jurisdictions, we have a category that clearly works at scales, right? So stablecoins basically proved that tokenization is not just theory; it can easily operate and cater to like millions of users. I think in terms of what's next beyond stablecoins, financial instruments seem to be the clear next choice. Things have obviously moved from pilots to actual production. Tokenized treasuries, like we've seen the BlackRocks and Franklin Templetons and so on and so forth, who've already moved billions on chain. And I think access is only one part of it, like democratizing access. A lot of the reason why this is being done is operational efficiency. It does cut settlement times, it does improve collateral mobility, and it does give institutions intraday liquidity, right, which is kind of important for the day to day. And then I think we would also probably see clear use case for where any asset that sits on a clean registry is kind of ripe for tokenization. We've seen some of that in UAE, for example, where I would like to say it's the first jurisdiction that has gone ahead and done like native real estate tokenization, where the real estate registries themselves have been tokenized instead of creating an SPV structure. So I think any registries based asset is probably one of the first assets to be tokenized and given that kind of legal recognition. But I think what's really important, and it's a pretty nuanced view, is that tokenization itself, or bringing something on chain itself, is not the biggest win, right? Like, it does not mean the asset is suddenly liquid. I think the real value will come when these tokenized assets can actually do something, right? settle, be pledged, move across borders, interact with other tokenized instruments. So we are nowhere near a default, and we are still figuring out what to do with these assets, right? So bringing them on chain is probably just the step one.
I think you bring up two really interesting points, and I'll move over to you, Andre, here. But the first being, it's not just everything's going to be tokenized for the sake of being tokenized. It's what do you do once it's tokenized, and I think we could probably spend a whole podcast on that. How do you digital identity and all the other things that come along with that. But then secondly, I think you bring up a really interesting and valid point, which is, we talk from the technology layer of blockchain and crypto, abstracting away the user experience to make it easier to onboard people. I think the thing that does that best is what people are already used to, and stablecoins, I agree with you, I think are going to be a big catalyst in kind of the adoption of the tech. But Andre, I want to hear your thoughts on tokenization of RWAs wherever you want to take it.
Yeah, the way I've put it in to family and friends who are not, as we are, in the Web3 space, is that tokenization is an upgrade of the internet. It's a technical piece of infrastructure. And as Arushi just said, it's no pass or no guarantee to success, because it's not because you're tokenizing something that you can sell it. If there is no liquidity, as Arushi said, then of course there's no one to buy it. So liquidity is something else. But tokenization is the first step to achieve a more a cheaper, faster, and more verifiable. These are the three words I wanted to share with you. Cheaper, faster, more verifiable piece of infrastructure. Because take the use cases with, for instance, USD stablecoins. Today, on correspondent banking operated by SWIFT or any other network, you need to go through a US entity to clear USD in the US. USD indeed in the US. Now, with a USD stablecoin, you can exchange the token without going through a local clearer in the US, because there is no need to go to really move the money. You just move the token, and moving the token is cheaper than moving the real money. Really, moving the real money, this is what SWIFT is doing on a day-to-day basis since 50 plus years. It's making sure that the currencies can be indeed cleared in their country. So you need to move the money back to the country for clearing and settlement. With the tokens, you don't need to go that. I was wondering recently, could we see some countries adopting USD tokens, USD C or USDT or whichever USD stablecoin, for domestic purpose, because it might be more efficient, more attractive, and more stable for their economy than continuing to use their own local currencies, when emerging market currencies dropping in value. So that's one first use case. Verifiability, in my view, is the key to tokenization as well, because it's a technical feature, and tokenization is all about indeed making sure we exchange value, not only information. So it's the move from Web 2 to Web 3, and Internet of Value is something we heard about since a decade from some players like Ripple. And verifiability, take BTC versus gold. To verify that what you see is real gold, you need to melt it. So what is the cost of verifying gold is real gold? It's huge, if not impossible to achieve, when you have lots of them, like a country wishing to demonstrate it really owns the tons of gold. With BTC, you can verify it on chain, and you can do it publicly without any transformation of the asset. So that is another. That's how I see it. Tokenization is a piece of technology, an infrastructure that enables various use cases, and that basically achieves cheaper, faster, more verifiable exchange of value.
I think one of the things talked about a lot, and I know, both of you kind of really nailed out stablecoins as kind of the different roles it can play in kind of infrastructure now and kind of future. Obviously, USDC, USDT, other stables are very important on some of these, layer one networks for blockchain. I guess the question is like, where does that leave native layer one assets? So like you have USDC, USDT playing a major role in these ecosystems. Where does it kind of leave the native kind of, digital assets on these networks? And I won't name any in particular, obviously, but just kind of broad thoughts maybe on that, because this space is always kind of evolving. And I think that this is something I see asked a lot. So.
Yeah, layer one tokens are just there, in my view, to pay for the use of the network, because someone has to pay the electricity in a distributed network or in a centralized network like Swift is. Someone has to pay the consumption and the operations, and the layer one tokens are there to not only charge end users for their use of the network, but also to enable additional features like the smart contracts, the conditional execution of particular contracts. So those layer one tokens are not meant to be stable coins. They are really there to pay for the whole distributed network operations. And we know layer ones now these days have become a commodity. There are so many, and they are very specialized. So this year I changed my perspective. Those layer ones are not competing against each other. They are really, if they want to succeed and strive, many will disappear in my view, but they need to be very specialized on particular use cases or features or geographies sometimes. And like websites today on the internet, in the Web 2 world, the websites do interoperate. Like, you click on a particular option and that goes to Google Analytics before it goes to somewhere else. And then you end up with the window you're expecting to see to make your purchase, for instance. I mean, a typical experience, a user experience from Google search to a commercial website will go through multiple websites, and they work together to achieve a particular end-to-end process. And on chain, it also will go this way. You're going to have a chain for identity, a chain for USDT or USDC, or another chain for indeed smart contracts implementation. And it's not that one chain will cover all capabilities you need. You will need to be using multiple chains, and it will only become successful, in my view, if we start not thinking about them anymore, not seeing them anymore, and if they can scale by being really abstracted through a very user-friendly layer. And
Yeah.
my preferred case is Revolut. As an example, I use Revolut for business mainly, and Revolut doesn't show whether this is a fiat account, a crypto account, have you bought a stock or a crypto asset. You don't see the complexity. And that's where those technologies start scaling, where you have indeed user experience that are abstracting all of those concepts and underlying technologies.
Arushi, I would love your thoughts just briefly on that, kind of where you see the role of, some of these native layer one assets kind of now and then moving forward. And then we'll rapid fire through the rest. I know this is like, I don't want to take all of you guys' day up. I think this is a great conversation, so I want to make sure we get to everything.
Yeah, I'd agree with Andre, right? Like, L1s are there to secure the network and to perform network functions, and stablecoins are clearly emerging as a payment and settlement layer. Like, just to give you some data, right? Like, stablecoins are 10% of the entire crypto market cap, but they contribute almost 60% of the volumes, that the transactions that happen, which tells you very clearly that stablecoins have kind of come about to have a specific function in the ecosystem, and so they're not competing; they're clearly complementary. And the fact that all these stable coins end up being utilized for payments and settlements on these different layer ones tells you that they're working together. It's not a competition per se. So yeah, kind of echoing what Andre has already said.
So I guess I'm going to move briefly into, I think we talked a little bit about this already, but if there's, further thoughts or different points, but aligning technology, institutions, and policy. So we're seeing policymakers, regulators, banks, fintechs, public blockchains, all moving in parallel towards digitization. So, what's the biggest challenge in aligning technology, policy, and institutional requirements? Is the barrier primarily technical, regulatory, or cultural, or maybe a little bit of all three? Andre, we'll start with you here.
Yeah, there is more and more alignment for sure, and the policymakers are watching each other. Also, there is a bit of peer pressure. Because indeed, this is a new industry that we are building, like Web 2. The internet has created a huge new industry since the late 90s, and tokenization, Web 3, digital asset technologies will do the same. And there are geopolitical challenges, like making sure that from the US side, I believe the US wants to get all the kids on the planet to start using USD stable coins rather than their domestic future stable coins. So they can fund the deficit and buy treasuries. So there are big ambitions there. So there is full alignment in those countries, and the US has been very progressive in this year, 2025. Now there are indeed still barriers, because, like in Europe, they don't get it the same way at the level, in particular, of the European Central Bank. They don't understand that it's a piece of infrastructure. Digital assets tokenization is a piece of infrastructure for the economy to thrive, rather than they would prefer to use it for their own purpose, for surveillance, tracking, and fighting money laundering, which is important, but that should be a second priority. The first priority should be to indeed grow the economy on the basis of that piece of infrastructure. So the role model for me is definitely the US since the beginning of this year in terms of policy development, and also the UAE. Arushi will know more. And might also cover some challenges, if any, there. But I see the UAE also very advanced in terms of visionary policy developments to support the growth of digital asset technologies.
Arushi?
Yeah, just to add to that, I think all these different parts of the ecosystem, they're all moving towards digitization, which is the goal and the outcome we're all hoping for. But I think the issue is that everyone kind of moves at a different pace, right? Like technologists, they are usually far ahead. We have all the technology. We had most of this even 5 years back to tokenize everything that we wanted to. We probably didn't have the policies and the people who could do it, right? Who wanted to do it. Today, we have some of the policies. They're not fully fleshed out, but they exist. But I still feel the biggest challenges are usually not technical or policy based. The policy, I think, can be both an enabler and can also slow down things, sometimes deliberately. But I think the far bigger challenges are coordination and incentive to move. And those kind of define where things eventually land up. So, yeah, I mean, technology, I don't think is a challenge. Policy to a certain extent, and then incentive to move and coordination between different ecosystem players. And I'll just give you a very short example, right? Banks, for years, they were unwilling to work with the crypto firms, and debanking was a real issue. And to some extent, it still is. Only a handful of banks, whether I talk about the US or even UAE or any part of the world, only a handful of banks would even touch crypto clients, which created its own concentration risks, right? So, what has changed recently? Technology is pretty much the same when it comes to crypto exchanges. I'm sure they've upgraded, but that existed. Policies have changed, which means there's a legitimacy and there are guardrails built around the activity, which makes the banks a little bit more comfortable with engagement. But what has really changed is now they're seeing, their peers move sometimes. There's a lot more education, there's a lot more confidence. They're seeing large global institutions enter the space, and that shifts the comfort level that they have, and the risk perception is changing. So I think it's a bit of both, but I would kind of put it at different levels.
Yeah, I think it's a great point. I think both of you kind of saying similar things too, where you have like kind of the incumbents, and it's like, okay, well, what's going to actually force the change? And I think Andre paints that picture where it's like, if you start seeing some initiatives coming out of different nations in the world, it's almost like the good old, nobody wants to be first, but everybody wants to be second, third, fourth, and fifth, and however that goes. All right, I'm going to move us forward a little bit, and we are seeing, and I would love, both your guys' thoughts on this. We're at a very interesting time for humanity, I think. So we have kind of this convergence of what's going on with AI and digital identity frameworks and blockchain and DLT. So I kind of want to ask how both of you see these technologies converging into kind of this future digital infrastructure. What new opportunities or risks emerge as these technologies converge? And then really kind of fortify this in the fact of like how valuable is trusted data, since all of this stuff is happening. My personal opinion is this fits blockchain and distributed ledger in almost a perfect storm scenario for auditability, transparency, traceability, provenance, all that stuff. But what are your guys' thoughts on just what we're witnessing as technology kind of converges?
Yeah, so indeed, the fraud use case can, or the challenges can benefit from tokenization and the increased transparency we get through on-chain transactions and tracking of transactions. And as regulators understand the value of this new technology for their own purpose, such as fighting fraud, fighting financial crime, they will indeed start thinking about taking advantage of the technology. Like we have seen with, it took 20 years for regulators to understand that electronic invoicing was important to fight VAT fraud. Because 15 years ago, still, we were thinking at Cybos, I was running sessions on electronic invoice and what is the value of electronic versus paper? The electronic could be fake. Of course, paper could be fake as well. So regulators have really evolved, of course, through experience, 3 decades of enforcement, where they really now taking a perspective whereby technology can help them force transparency into the market. Indeed, payments is full of regulations. Trade is less supported by regulators today because it's more of a niche market. But fraud and financial crime is all over the place. The new technologies enable new types of fraud, and the regulators can be better equipped with those new technologies. So I think that's the use case, coming back on Arushi's point around the adoption challenge, which is indeed one we face in trade as well when it comes to introducing new technologies. The adoption challenge can be tackled if we're looking at the whole financial crime compliance theme, where the business case to use the new technologies or to force the market to use technologies is often becoming obvious.
Yep. I think it's interesting too from the trade standpoint where you mentioned it's considered at certain levels more of a niche area. But what I find fascinating is like there's probably so many intangibles that happen or are going to happen in the future because of blockchain adoption that is like we can't even really measure right now, like new business models, new use cases, processes get streamlined, all the downstream effects of faster and more efficient trade. It's like, how do you even measure that? Because it's not happening right now, but it's going to happen. A couple more questions, and then we're going to ramp down here. But I think we've also seen a shift, public versus private infrastructure models. So looking ahead, and I think, Rushi, maybe from your standpoint for policy, this is interesting. Do you believe global systems will rely more on public blockchains, private networks, or hybrid models? What characteristics matter most for broader adoption, whether it be compliance, interoperability, openness, or something else? And there's, I guess, as a sidebar from me, there have been a lot of initiatives that are allowing institutions to be able to dip their toes in from the privacy standpoint. But I wonder if there's going to be a hybrid model or a crossover in the future, or what you kind of think about that, Arushi.
Yeah, I think having worked in the space for a while, and generally, if you look at even the historical context, everything eventually converges, right? We started with the idea of a trustless Bitcoin system. And what we really ended up with is a Bitcoin that's primarily a store of value, but then a dollar-backed token issued by centralized entities on public chains that eventually got adopted by millions and billions of users. So it's very pragmatic outcome. It's not wrong, and I think that's a good indicator of where we are headed when it comes to the whole permission versus permissionless debate. Right? In reality, I think both public and private chains will coexist. Right? Permission networks are where I think particularly large institutions, they kind of feel very safe. That's where they go and experiment, right? But I think that comfort is also shifting because they're finally starting to realize the value of public chains, which is, they are a lot more accessible. If you want to talk about liquidity, you will go and find it on public chains. Unlikely you will find it within your private chains. There's the developer base exists, the pace of innovation, everything there is a lot more magnified. But I think one thing that really holds them back is how to manage the risk of entering this wild west, for lack of a better word, right? The permissionless chains. So that's where I see a lot of conversations heading. Ultimately, it depends upon what you're trying to achieve, right? Like, I know a lot of players who are starting out in private chains, but they go and plug themselves into public chains, or and it's not one public chain. They will go and plug themselves into multiple public chains to do what they have to do. I mean, it's a better option than relying on trying to interoperate multiple private networks. We've seen that's just not possible. It's been unsuccessful in the past, and I doubt it will be successful as much in the future, particularly when we have the public chain infrastructure in front of us. So I think the short answer is I don't see one particular model winning. It is a layered world. We will reach a convergence point where both of them will exist together, and each kind of doing what they're best at.
I think it's interesting too, because I mean, we do, every once in a while we see proof of concepts from the traditional, like incumbents, whether it be banking or whatever it is, or enterprise, that have been like going on for like years, like 4 or 5 year proof of concepts. And then you finally see an announcement and you're like, oh, this has all been going on in a private environment for years. And I had no idea about it. So Andre, your thoughts briefly on public versus private, then we'll get forward looking statements, and we will ramp down before an hour here, I promise.
Yeah. As I see blockchains as an upgrade of the internet, any website has a public a set of public pages and a member only area where you log in into a website to do something special with your own assets, your own business, and that's a private side. So, as Arushi said, it's a coexistence of public and private for websites, but similarly on blockchains, because they will all be highly specialized and work together like websites do. The coexistence of public chains and private chains makes sense. What it could also be influenced by is the size of the community around the chain. If you're a small, well-defined community, you don't need to be public. You can use a private chain, and some networks like XDC Network support, hybrid models, public-private. What another factor influencing private versus public is the regulators. Like in Europe, we have EIDAS2, which is the evolution of the electronic signature regulation, which is being debated because public blockchains are not accepted unless they have an entity controlling them. So not a fully decentralized network, but an entity controlling the nodes, and the nodes of the public chain have to be KYC'd. So that's another version of public that the regulators are suggesting. There's no decision yet. It's being debated in Europe, and that will be the outcome of EIDAS 2. It shows also that blockchains are entering key regulations in order to upgrade the way we're using the internet.
I want to ask, and this is just very briefly, Andre, I do not want to waste too much time on this, but we know ISO 20022, the deadline just happened. And I think there's a lot of misconception too, where it certainly unifies messaging and, you know, between different entities, and obviously sets up for things like blockchain and distributed ledger at the whole level. But I often see like this individual digital asset is an ISO 20022 asset, and this one is like, what are your thoughts just broadly on that? What is ISO 20022, just very briefly, and what does it mean, I guess, for the industry at large?
Yeah, it's a structure. It's an industry standard, ISO 20022. That's why it starts with ISO to structure a financial message. And basically, if you can exchange any data, you can exchange any ISO 20022 message. So having an ISO 20022 compliant token or compatible token doesn't mean much in my view. It's more important to know, is it proof of stake or proof of work? I mean, this is really core to the blockchains at a high level, and there are many other options, of course. Though the consensus mechanism is key. The fact that a token can store ISO 20022 messages, like you store an image, you store a piece of text, whatever the content, you can handle it. I guess all layer one networks can handle any content. So this ISO 20, the focus on ISO 22, as you suggest, is kind of irrelevant.
Yep. All right. So this is kind of where we get into the forward-looking statements the next handful of years here. You know, as an outsider looking in and doing, you know, some digging into this space, you know, you see just like these. I'm always interested in the tokenization estimates from some of these like big banking entities and everybody else, because I mean, talk about a range in numbers. Like you literally will see like 2 trillion in stablecoins by 2030, and then another entity's like, no, 3, and then like, and then from a tokenization standpoint, I've seen numbers that like literally go from like 3 trillion to 30 trillion. So it's like everybody's like just throwing a dart and just being like, we have no idea what the actual number is going to be, but stuff's happening. I would love to hear, you know, both of your thoughts on digital transformation, where you believe the most significant shifts are going to be in global finance and digital policy by 2030. And I'll start with you, Arushi.
Yeah, I mean, 2030 is still about 5 years away, and let's face it, 5 years in crypto is a long time. We would probably have lived through multiple cycles, and maybe 10 new acronyms and another 10 new predictions. So, but if I had to take a guess, and I will not talk about stable coins and tokenization because I feel like that's anyways top of mind, and I'm sure something is going to be doing there. Something big is coming out of there, but. If I had to just take a guess, one is I think the supervisory tech stack, right? Like we keep talking about how regulations need to evolve, but we don't talk enough about how the supervision also needs to evolve. Regulators traditionally have relied upon quarterly reports and monthly reports and so on and so forth. I think that all needs to change because we now have the data to a certain extent to do more real time monitoring, and that entire regulatory and supervisory tech stack needs to be upgraded. So I see that as something that I think should change by 2030. Uh, Secondly, I think privacy is going to become a major policy focus as hopefully, and as more and more assets go on chain, I think we are going to be talking more about privacy preserving compliance. We're already seeing some aspects of it come out, like selective disclosures and zero knowledge proofs and so on and so forth. But I think it's going to be a really hard area, but a very important area to solve. And I think the last one, and we spoke about this a little bit, is the whole convergence of AI and crypto. We'll probably see that happen, and we'll probably see a lot more automation when it comes to risk signals and machine to machine payments and so on and so forth. So yeah, those would probably be my top three.
I think, Arushi, it's interesting too, because with AI and agentic AI, and you talked about unification across different jurisdictions, it seems like if they could, if we could actually vet the data going into these models for AI, that they would almost be perfectly suited to help with things like reg tech and like the regulatory technology end of things. Like, because different jurisdictions have different laws. And at the end of the day, like, how do you streamline, the ability to comply with those laws? It seems like AI is set up to do it, but you just have to really make sure that that data is, pretty accurate to
Yeah.
make sure you're doing it correctly.
Yeah, we can't have too many false positives or false negatives there.
Yeah, like not using chat. You can't use Chat GPT for it.
Oh, 100% no.
Andre, forward-looking statements. And yeah, thank you guys both so much for joining today. I thought this was awesome. We should do this again in the near future. But Andre, where are we headed at wherever you want to take it?
Yeah, I think that the next 5 years is the last time we're going to talk about tokenization. After 2030, we won't be talking about tokenization anymore because traditional finance will have embraced tokenization so much, we'll go back to the classic themes of money, investments, the real financial capabilities, use cases that we can improve. And lots of TradFi firms will be wiped out because they couldn't follow the rhythm, or they didn't believe in the transformation of financial markets. Most of the bigger boys will indeed take advantage of the new technologies and will thrive based on those. And some early adopters of tokenization and that were born in the Web3 space will indeed start competing with the major incumbents because they will be crypto native and they will be able to offer a level of abstraction that will make their platform much more user friendly than most. And this is the kind of Apple Revolut kind of interface that I'm looking for, really differentiating by design and taking advantage of technology as much as possible without showing it, basically. So in my view, the next 5 years, we'll still enjoy talking about technicalities, but after 2030, we won't talk about tokenization and digital assets anymore.
I love that. And I think that I heard the same thing from Arushi too, where it's like, maybe we'll have more acronyms. And I find it so interesting because in crypto and blockchain, we love to invent terms like Web3 gaming and like all these things where like in 10 or 15 years, people aren't going to be calling it Web3 gaming. It's just going to be called gaming, and it might have Web3 elements baked in, but we're not going to be we're not talking about TCP IP right now, or how cool it is that we all have different email providers and we can interoperate. Like, so anyways, Andre, Arushi, thank you both so much for joining and sharing your insights on the future of digital markets, tokenization, and global policy. I want to give another huge shout out to the XDC Foundation for making conversations like this possible. To everybody watching, we appreciate you. Make sure to follow Genfinity for more interviews across digital infrastructure.